Back here at, where are we today? We're at the University of Houston, the Bauer College of Business, about to go live with our weekly Zoom meeting. So, we're going to talk about investments today. I'm going to talk about 4 investment strategies that are designed to help you maximize returns and minimize risk. So, we'll get started in just a minute. I'm going to jump on over into the Zoom platform and let some students in. If you're watching on YouTube or video, YouTube is video. If you're watching on YouTube Live or Facebook Live, welcome. And this will be posted to the podcast Missional Money. That's kind of new. The podcast isn't new, but we're taking this lesson to the podcast at Missional Money. So you can subscribe in iTunes at just search Missional Money. You'll see my picture. You can jump in and subscribe to Missional Money. And sometimes we post the lessons that I teach at the University of Houston in Money Study Group. Sometimes we post those lessons to our podcast. So we're going to do that today. So let's go jump in and let everybody in. It's 10 a.m. So let's admit some folks. Hey, good morning. Good morning. Hey, Harsh, I see you there. Can you hear me? Can anybody hear me? Testing. Sometimes we have trouble in the Zoom meeting with all of this technology. Anybody hear me? Somebody chat. Yes, thank you very much. All right, Helen, thank you. Welcome, everybody. Okay, cool. Well, let's get ready to get started. As you know, we don't really start until 5 minutes after because we certainly have some students who show up a little bit late, pretty common. And so we will not really get started until 10:05 a.m. Hope you guys are doing great. We are going to talk about investments again this week. Investment is the most popular topic in the course for personal finance. And so if that's true, and it is, today's lesson, the 4 investment strategies that are designed to help you maximize returns and minimize risk. This lesson is hands down the most popular and helpful lesson in the entire course, most popular, I should say. The truth is that investments are not the most important part of your financial planning strategies. On the other hand, investments are pretty important, and understanding investments is important. So this week we're going to jump into 4 investment strategies that are designed to help you maximize returns and minimize risk, and especially for those of you who are younger than me and younger than my wife, who's only 30. She's older than 30, but we celebrate her 30th birthday every year, as you might imagine. But if you're young and you're planning on starting your investment program, these 4 strategies that I'm going to go over today are super essential. And I would say that these 4 strategies include, and encapsulate everything you need to know to be a very, very good investor. So will it make you an expert? I think if you learn these 4 strategies and you understand how they work, if you do that, if you apply yourself to that, if you make that if you commit to doing that, I'm going to introduce you to these 4 strategies, and I will cover a lot of information in the next hour. But in the process of doing that, I'm going to be covering some things that are basic elements of investing. And if you put those together and you understand these 4 strategies, you will in the next hour, you will learn what you need to learn to become really an expert investor. And I say expert, meaning that your skills, your investment skills, will go from wherever they are now to the level that they need to be for you to become a do-it-yourself investor. You will save a lot of money over your lifetime. You will make a lot of money over your lifetime. You will build wealth using these 4 strategies designed to help you maximize returns and minimize risk. So that's what we're going to do today. We're still waiting for a few more folks to show up, and I'm going to, as always, encourage you to leave any questions you have in the chat, and I will answer those and get to those before we end the call, the Zoom call. So again, if you're watching on Facebook Live or YouTube Live, welcome. I hope you will participate by leaving comments, and don't forget to like the video. If you're in YouTube, that helps. I don't know what it helps, but if you hit the little bell there on YouTube, then I will chase you down every week and leave, very pesty little remarks and remind you every time we post a new video to the channel. So you can do that if you want. All right, it's 10:05. It is time to officially start. So I want to introduce you to Professor Snooze. This is Professor Snooze, and he's talking about investing. So that's me. I put on a little weight since then and lost a little more hair, but anyway, that's an illustration in my book, Make Your Money Count. My friend Taylor Springle did these illustrations. Fantastic job. But the idea was, we're going to talk about investments, and it's going to bore you to tears. It's going to bore you to sleep. That's what this illustration is about. So I'm going to try not to do that. I'm going to try to make it very informative. And like I said earlier, this really is the lesson. If you're interested in investing, if that's part of why you took this course, because you recognize that your financial future is determined by what kind of plan you have to be successful financially, then this course is for you. But in addition to financial planning, investment management is a big part of financial success, and certainly a big part of building wealth. And so today we're going to cover 4 strategies, 4 investment strategies designed to help you maximize returns over your lifetime and minimize risk. Doing those 2 things together really improves your probability of success. And so you're going to, let me jump into the assignment that you're going to do this week, so that those of you who are students at the Bauer College of Business, your grade is what matters most. So I want you to know, as we start this Zoom call, that this week you're going to do something a little different. You're going to outline the video, and you're going to timestamp the video. So you will want to take some notes. And again, this video will be posted to our playlist. You know where to find that playlist. Just go to moneystudygroup.com, click on the YouTube emblem or symbol, icon, whatever, at the top right, and that will take you to this semester's playlist. And as soon as this is over, this Zoom call is over, I will take that YouTube video and I'll put it in the playlist. And that's where you're going to want to go. If you want to rewatch it, you can watch it at high speed if you'd like, because you can listen a lot faster than I can talk. But this is one that you may want to favorite, you may want to save, you may want to watch again, not because of your grade, but because what I'm going to cover today, I'm going to cover a lot of ground, and you're going to want to understand it. So 4 investment strategies designed to help you maximize returns and minimize risk, and there they are on the page. I think you can see that if my face isn't in the way. Let me get my face out of the way. So diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. So those are the 4 main topics for today. But before we do that, before we jump into these 4 investment strategies, what I want to do is cover something that's very important. It's asset classes. So if you want to understand these investment strategies, one of the things you have to understand is asset classes. So I'm going to check in the chat here on Zoom, and I'm going to see if anybody has if any of you can tell me what is an asset class. Just give me, if you're watching on YouTube or Facebook, leave a comment. Tell me what you know in a quick paragraph about asset classes. So that's a clue, and it's a very important topic. I can't spend a whole lot of time on asset classes. Asset classes. What is an asset? What is an asset class? I'm going to cover it briefly, but I want you to know it's something you're going to want to learn about. You're going to want to understand asset classes, because without that knowledge, that foundation, your investment knowledge will be very sketchy at best. So the different with similar investments with similar properties. Harsh, that's good. Mercy says that the different types or levels of assets, that's getting closer. An asset class is a group of similar assets. Okay, that's great, Jacob, but give me an example. You're right, but tell me, what is an asset class? So maybe that was a better question. Name an asset class, and we'll start there, and I'll go over. Mercy says stocks. So that's pretty general, Mercy. Stocks, that would be equities. That's not really an asset class, it's an asset category. But inside of stocks, inside of equities, inside of that category are certain asset classes. So Jacob says cash. Yes, cash is an asset class. I mean, it's an asset. It's an asset. What are we talking about? Asset classes, asset types. So cash is one, bonds, stocks. But within stocks, so we got bonds, we've got equities or stocks, we've got cash. But in each of those, there's a different asset class. So let's talk about stocks. That's a good one. That's a big one. That's an important one. So inside of stocks, we have different asset classes. So I'm going to show you my favorite investment of all time. It's called SPY. So when we go to SPY, what we're looking at is, if you can see my screen, we've got on the left all of these different tickers. So these tickers, each of these ETFs, I'll talk about ETFs in just a minute, but each of these tickers, each of these ETFs, exchange traded funds, are different investments, and they're different asset classes. So SPY, my favorite investment of all time, is basically a proxy or a replacement. It's one investment that you can invest in that gives you exposure to different asset classes. But the primary asset class in SPY is called large cap. So if I say large cap is an asset class, which it is, what does that make you think of? What would some other asset classes be if large cap is an asset class? What other asset classes could you think of if I told you that one asset class is large cap stocks, large cap US stocks? So while you're thinking about that, and leave a comment if you're in the Zoom room, do that, leave a comment. What are some other asset classes? SPY, my favorite investment of all time, represents large cap stocks. Not only large cap, but US, United States. So S&P 500, think S&P 500, SPY is the S&P 500. It's a proxy, in other words, a replacement. It's kind of like a mutual fund. Do you know what a mutual fund is? A mutual fund is a type of investment. Just like an ETF, an exchange traded fund, is a type of investment. A stock is a type of investment. So inside of SPY, there are 500 stocks, because that's what the S&P 500 is. The S&P 500 is an index of 500 stocks. They happen to be the 500 largest companies, 500 largest stocks in the United States. Think about that for a second. If they're the largest in the United States, for the most part, they're the largest in the world. And they're companies that do business around the world. So if you wanted to invest in the 500 largest, most successful companies in the world, the easiest way to do that and the most cost-effective way to do that would be to buy SPY. If you buy SPY, this is a chart. This is a 2-year chart of the SPY. So if you would have bought this, if you would have bought it back in March of 2000, you would have bought it at a pretty low price, like $220 a share. And today it's trading at $452 a share. So that is that's an asset class. And in your investment scheme, this would be a good holding, SPY, because you would be able to buy one investment, one exchange traded fund that would represent all of those companies. It's very similar to a mutual fund. A mutual fund does the same thing, except a mutual fund charges extra fees because there's a manager who's picking those companies and selecting those companies. And SPY is it's not a mutual fund. It is an exchange traded fund, which is very similar. So mutual funds, index funds, exchange traded funds, those are 3 different types of investments. But that's not the asset class, that's the type of investment. It's how you're making the investment in whichever asset class you're choosing. So I know that may seem kind of confusing, and that's why I tried to set the table and encourage you to recognize that asset classes are important. And you need to understand asset classes if you're going to understand how these 4 investment strategies work in your investment program. It's not that complicated, but if it's new to you, it is a lot of information that you have to kind of categorize and understand a little bit. But if you'll just think about investing in a large company versus a small company, so no one has chimed in with an alternative to large cap. So what's a different asset class other than a large cap US stock? Somebody chime in in the chat box and give me an answer. And if you're on Facebook or YouTube, so thank you, Tanya. Yes, small cap. Do you know what that means, Tanya? A small cap? I see you. I don't hear you. You're muted if you're talking, but you can shake your head or not. Do you know what small cap is? Small business, yeah. Yeah, thank you very much. It's good to hear your voice. I rarely hear voices except for my own, so I'm going to show you a small cap, Tanya, because this is a company that I like. It's called Lucid Motors. Now, this is not a recommendation to make an investment, but this Lucid, it's a brand new company. It's a very small company, and they make electric cars. They make electric cars that are kind of luxury cars. So I'm going to show you a 6-month chart. You see how much it goes up and down? That's one of the things that happens with small company stocks. Imagine if you were making an investment in a company, a small company, it's going to start out with a lot of risk. But it also has the potential, as all investments do, this is an important, highlight this point, all investments have risk. The more risk they have, the more return opportunity they have, because you're taking the risk. That's always true about every investment. If you want to have outsized returns, you're going to have more risk. And that's why managing risk is so important, and understanding risk is so important. And that's why these 4 strategies that I'm going to show you today are so critical to your future success. And so understanding asset classes is essential, because if you can recognize the difference between a company like Lucid, and that's one company stock, if you invested $10,000 in that one company stock, you could make a whole lot of money, and you could also lose your $10,000, because that company could do what? What do many new companies end up doing? Many new companies, small companies, startup companies, they cost a lot of money to get going, and they get going, and they get going, and what ends up happening to a lot of small companies? failing. Exactly, Mercy, they fail. Small companies, startups have great opportunity for reward because they have great risk. And that's okay. Risk and reward go together. They correlate one another, and they're very important for you to understand risk. Do I have a question? Tanya, there you go, thanks. Did you have a question, Tanya? No? Okay, thanks. I see you shaking your head. Nobody else can see that. So anyway, these small companies, I'm not saying you should avoid them. I think you should understand them, and I think you should also understand the importance of investing in an investment, not a company, but an investment like SPY, because if you had $10,000 to invest and you invested in SPY, you saw the chart, you saw how much return, and there's much, much less risk investing in SPY, the large cap U.S. companies. There's less risk investing there than there is investing in small cap. So those are just two asset classes. We could get into international. So a company doing business in Bangkok that's headed in Bangkok is going to be different. It's going to have a different risk profile than one in the U.S. Or a good example would be a Chinese company, because of the way that China is not very transparent and the government controls everything in China. The investments that you make in China have another layer of risk. So international stocks, even though they're stocks, they're investments, you're investing in a company, you own part of that company. When you do that, that's a different level of risk. And that's why, again, the SPY is my favorite investment of all time, because the expenses to invest in SPY are very low, like 13 basis points. That's like not 13%, but 13% of 1%, if that makes any sense. 13 basis points. And if you invested in a mutual fund and you paid a manager, you could pay like 1% or more. Just to have that manager picking stocks, picking companies for that mutual fund. So I love ETFs, exchange traded funds, and I just want to plant that seed for you. If you want to become better at investing, you need to understand types of investments. That's beyond the scope of this lesson, but it's an important part of understanding so that as you move forward, you have a good basic understanding of types of investments. Just Google and do a little research. What is an index fund? What is a mutual fund? What is an exchange traded fund? And if you can compare and contrast those three types of investments, you'll be way ahead of the game, and it's an important part of understanding these four investment strategies. So we've got small cap, we've got large cap, we've got international. Those are all asset classes, and they all go up and down in different ways at different times. And there's one more asset class I need to mention, and it is bonds. So this is, I'm just going to show you a 20-year bond fund. This is another ETF. I like this ETF. If you look at that chart, that's a 1-year chart. This is bonds. So this is like the SPY, except this is for bonds, for government bonds, U.S. government bonds. It's an ETF, an exchange traded fund. And this one is something that typically what you would see, because bonds and stocks do different things. When the market goes up for stocks, usually the bonds go down a little bit. And so having what we call a 60-40 portfolio means having 60% stocks and 40% bonds. And over the last 20, 30, 40 years, that's been a good mix, because when stocks go up, typically bonds go down. Now, again, I'm not going to try to make you an expert on this asset class or on any asset class, but I do need you to understand the important principle that asset classes respond differently when there's risk in the market, when something happens in the world that creates market turmoil or volatility. Different asset classes perform differently. And bonds are special because over time, the last 4 or 5 decades, Typically, bonds will go up when there's risk in the market. Does that make sense? So most of the time, bonds would be considered safe. But if you look at that chart, does that look like a safe investment? I mean, I showed you the SPY. This is stocks, large cap US stocks. Look at that chart. Really good performance. Yeah, there's some ups and downs. But this SPY, based on the S&P 500, which is an index, that's another thing you might want to learn. What is an index? The S&P 500 is an index, and it basically mimics, it mirrors, it shows you the performance of these 500 US stocks. And the S&P 500, this is a proxy. In other words, you can invest in this one investment, and you're investing in all 500 of those. If you look at this chart and you compare this chart of these large cap US stocks with this bond fund that's supposed to be safe, here's the thing. The value of a bond is inversely related to the interest rate. So again, I don't want you to be an expert. I just feel like I have to make sure I say this, that interest rates are an important part of investing. You've heard about inflation, I hope. If you haven't, you've probably been watching CNN maybe, but it's not as alarming in the news as it should be. Interest rates, inflation are kind of tied together. They're part of what's happening in the markets right now. And what will happen, what is happening, what has happened, is the United States, the Federal Reserve, they've worked really hard to keep interest rates really, really, really low. And what happens when interest rates are low? Remember, the value of a bond is inversely related to the interest rate. So if interest rates are super, super low, what happens to the value of the bond? It goes up. Interest rates low, bond value high. What happens then if interest rates start to go up? And the way you control inflation, which we are seeing super high, like 5-6% and climbing because of the government printing so much money, what happens to the interest rate is the Fed has to raise that interest rate a little bit more. And every time that even is possible, anytime anybody even mentions it in the news or people in a position to make that happen, what happens to the value of the bond when the market thinks interest rates are going to go up? The value of the bonds go down. So if you're in a 60-40 portfolio, and you think that having more bonds in your portfolio is going to give you better protection, that's a little questionable right now because bond values are going to be going down as interest rates go up. And as we have more inflation, interest rates are going to have to go up. It's going to be a tricky piece of business. So all that is just part of understanding that different asset classes perform differently in different situations, in different market scenarios. So we covered large cap. What is a large cap stock, by the way? McDonald's, Coca-Cola, I think Apple. And so you can just imagine those are solid companies that have a relatively low amount of risk. And I showed you this company that I like called Lucid. It's just one of many, but it's a company that is making these electric cars. They're luxury cars. They're very expensive, but it is competition for Tesla. So this company wants to get a piece of the action that Tesla is getting, and based on my reviews and research, they're making a car that's going to be very comparable to a Tesla in terms of performance, battery life, and they look better. Because they're luxury cars. They're really cool. But anyway, that's just a small cap stock that I contrasted to show you as an investor over your lifetime, having these different assets, understanding these different asset classes is really important. So now let's jump into the 4 investment strategies that are designed to help you maximize return and minimize risk. So I told you what they were: diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. So let's start with diversification. This is just a picture of an elevator. Back in the day when I was learning how to invest, I had some friends, and we had some mastermind groups, and we talked and we talked. And really what I was trying to do was learn. This is an illustration for one of my early books. And it's actually in all of my books, as a way to communicate and educate about diversification. Diversification is the first and foremost strategy for investors. If you're not diversified, you're taking undue risk. You're taking risk that you don't need to take. So what we have here is a picture of two elevators, and it really was designed to illustrate a mutual fund. So you could invest in one company stock. That's the elevator on your left. And that elevator, let me move my face out of the way so you can see it. That elevator is got one cable, and if that cable breaks, your investment crashes, right? Pretty simple illustration. It's to help you understand what diversification is. So having one company in your portfolio is a bad idea. A lot of people that work at a company like, say, Enron, if you don't know about Enron, you might want to check that out. Enron was a company where a lot of people believed that the company stock was just going to keep going up and up and up. And I had clients at Enron, and the smart ones were diversified. They didn't put all of their company 401k into Enron stock. Instead, they diversified, and they did very, very well when the company collapsed. But for those people who believed what the company leaders were telling them, that there's never been a better time to buy Enron stock, and they doubled down, they were terribly disappointed in the results, and many of them are still living with that financial ruin. I know one man who he died of a heart attack from the stress. He was a millionaire, and he believed his leaders at Enron, and he just kept putting his money in Enron stock. He wouldn't diversify. So this applies if you're working at a company that gives you a great match for your 401k, and you can buy the company stock, and they just, don't do it. Don't invest too much in your own company stock, because to be diversified, you want to make sure you don't have too much of one company, for one thing. But if it's where you're working and getting your salary as well, that's a double lack of diversification. So diversification is very simple, but it's very important. On the right side, you see an elevator. Let me move my face out of the way. On the right side, you see an elevator that has multiple cables, and instead of one cable. So you see these guys are calm, cool, and collected, because they know somebody's managing which companies their investment holds. So this was designed, this illustration, years ago, to illustrate a mutual fund. So a mutual fund manager would look at all of those companies in that investment, that mutual fund, and he would look for weak cables, weak companies. And the mutual fund manager would say, I'm going to take that company out of the mutual fund, and I'll put another company in. And so not only did you have diversification, but you had performance opportunities, because you're picking and choosing companies. That's what the manager of a mutual fund does. But the same thing is true almost in an exchange traded fund, except you don't have a manager. So again, when we go back to the S&P 500, what you see in this SPY is it's one investment with 500 different companies, and so it's like an aggregate. It's a proxy for all 500 of those large cap stocks. And so that's why it's my favorite of all, because I don't have to pay a manager, and I get exposure to all 500 of those companies in one investment. And this thing trades like a stock, which means you look at some of these dips, you can buy this. Like today, right now, I could open my I'm not going to open it because my wife will get mad if I open my Schwab account, and I could show you, I could make a trade in any of my accounts right now. So if we have a weird piece of news and the market crashes, I could go buy some stock today. Or maybe we have some news and the market goes way high, I could go sell some right now. And that's why it's important to understand these asset classes and the types of investments. You cannot do that with a mutual fund. You cannot do what I just described with a mutual fund. And that's why, in addition to not paying the fees for the mutual fund, there's tons of restrictions in a mutual fund. Not true with an exchange traded fund. So the type of investment that you are using, ETF versus mutual fund, is helpful if you want to learn how to make money as an investor. So diversification can come in mutual funds, exchange traded funds, different asset classes. It's important, but mostly it's just don't put all your eggs in one basket. That's the first investment strategy that you need to understand if you want to manage risk in terms of maximizing your return at the same time you're minimizing your risk. Diversification is hugely important. So that's number one. Now we'll go to number two, the second investment strategy designed to help you maximize returns and minimize risk is asset allocation. So I think of asset allocation as like a balanced tire. I used to be a master mechanic, and so if you think about having a good balanced portfolio, let's say you have 4 different asset classes. Maybe I can draw this. If my Apple pencil is dead. I should have charged my Apple Pencil. If I unplug and charge it now and sync it up, I'll lose everything, so I can't do that. But just imagine a circle. Imagine a circle, a pie, in 4 quadrants. And asset allocation would mean, good asset allocation would mean that you put your large cap, your small cap, some international, and some bonds. And that would be asset allocation. And so having that, not only do you have the diversification, but you have asset allocation. So that again, those asset classes are going to go up and down at different times, but you're going to have a balanced portfolio. You're going to have good asset allocation. So asset allocation, you'll hear about it throughout the rest of your life if you pay attention to investing at all. Asset allocation is the single most important determinant of your portfolio's results. So let me say that again. Asset allocation is the most important determinant of your portfolio's results. So there's nothing else that's going to make a bigger impact on your results than asset allocation. So you're going to want to learn about asset allocation more and more as you develop, and as you start to invest, it will make a lot more sense. Once you start to put money into an investment, you'll start to really understand these strategies and how they work and why they work. But for now, I just want to plant the seed and help you understand that this strategy, asset allocation, is the single most important determinant of your portfolio's returns. And so it's important, asset allocation. And again, without understanding asset classes, asset allocation makes 0 sense. So again, you have to go back and understand, what is asset allocation? It's a way of systematically setting up your portfolio so that you use different asset classes. Okay? It's pretty simple, right? It's a very important strategy. So there we have the second strategy, the second investment strategy designed to help you maximize returns and minimize risk, is just getting your asset allocation set up correctly. And there's lots of ways to do that. There's no one perfect way, but just start thinking about asset classes and how your portfolio, your investments are set up and allocated with different asset classes. Okay, it's going to be part of your homework assignment, certainly going to be part of your capstone assignment. So you want to just start to think about it. I'll do my best to make it easy for you in your assignments, but you're going to have to do some thinking and just maybe a little research just to get familiar with asset classes and asset allocation. So there you have the second strategy. There's a tire balancing tire. So I think I told you I was a master mechanic for many years, and when I became an investment advisor, one of the things that helped me explain things was some of the things I did as a master mechanic. Balancing tires, I've probably balanced, I don't know, 5,000 tires in my lifetime. It's part of how I paid for college, was I worked as a mechanic and I did a lot of tires and batteries along the way. So anyway, that's asset allocation. That's the illustration from Taylor Springle. Big applause. Let's give applause if I can. If you're on Netflix, it's time to come back. You can watch The Closer with David Chappelle later. This time, it's time for investments. So here we go to the third investment strategy. This is my favorite. This is the one that I consider to be the most powerful investment strategy for younger people, and I'll tell you why in a minute. But this is called dollar cost averaging, and we're going to use an illustration of Farmer Joe, and I'll show you what it looks like. Since I don't have an Apple Pencil, fortunately I have a completed, so this is what we're going to show you. We'll go back and forth, but I'm going to walk you through this illustration so that you understand it. But again, it's important that you understand different asset classes operate in a different way, and if you understand that, this illustration is going to help you understand how you can make money using dollar cost averaging in your portfolio. And again, we talked last week about the perfect investment. Anybody remember what the perfect investment was? Please leave a comment on YouTube, Facebook. What is the perfect investment? Because the perfect investment and dollar cost averaging and the other two strategies that we used, and the one that I haven't even talked about yet, portfolio rebalancing, all four of these investment strategies are designed to help you maximize return and minimize risk, and they work super duper well in your perfect investment. So if you can tell me, what is your perfect investment? What is the perfect investment? Yes, Mercy got it. Mercy's the only one. Mercy got it. Mercy gets an extra 100 points this week. Not just kidding. So the perfect investment, if you don't remember that, you should go back and you should watch that video, because if you didn't learn about the perfect investment, then these strategies that you're learning today are going to be pretty worthless. You may still get an A in the course, but what a failure to miss out on the perfect investment. So what is the perfect investment? If you're watching on YouTube, Facebook, leave a comment. And if you're in Zoom, Mercy is the only one so far. I think maybe, I don't know, maybe nobody's listening, Mercy. Oh, I see Tanya though. And Harsh, I know you're there, even though I can't see your face. Okay, so dollar cost averaging. Farmer Joe, a client of mine, had this farm, and he wanted to increase his revenue. He wanted to diversify a little more. He wanted to expand his operation. And so to do that, he decided he wanted to invest in cows. So he calls me up. I'm his investment advisor, helping him make a strategy so his farm will be successful, financially successful. So, okay, great, Joe. He didn't have any cows. He had chickens. He had pigs. He had other little animals and chinchillas and corn and soybeans, I think, maybe even some cotton. In Texas, cotton grows pretty good. So he had all this stuff, but he didn't have cows. And he said, I could use cows for hide. I could use cows for milk. I could use cows for beef. I like barbecue. I'm a meat eater. Hope that doesn't offend anybody. I love to smoke on my Traeger. So he's going to invest in cows. So we find out, okay, what do cows cost? What's your budget? That's what I really wanted him to help me figure out, is how much do you want to invest in a systematic way to invest in cows? And that's what you have to figure out when you sign up for your 401k at work, is how much are you going to invest, and how much of it's going to go into cows, and how much into chickens, and how much into corn, and yada, yada, yada. Those asset classes, remember? So that's where we're going with this illustration. But in this example, it's Farmer Joe investing in cows, because if you understand, if you follow this story, you're going to be able to go, I see how this works when we talk about different asset classes. But we're going to talk about cows. So how much do cows cost? When we start out, and I'm sorry my Apple Pencil's not working because it's dead, and if I charge it I'll lose my iPad over here, so failure to prepare. But here we have the first month, this cow cost $100. And Joe decided that he wants to invest $100 a month. Okay, that's how much he's going to invest in cows. That's his plan. So in this scenario, first month, how much does Joe invest? $100. How much are cows per head? $100. How many cows can Joe get for $100 in month one? Month one, he gets 1 cow. Okay, so he has 1 cow. So then we get to month 2, and cows are still $100. Actually, that's not right. I'm sorry to say, my illustration's not right. Okay, so the price of cows is $50, so it is right. Price of cows drops to $50. Okay, so how many cows can he get if his investment is 100? Okay, so this is right. It's not the price of the cow. This month, cows are $50. That should be $50. Oops. Instead of, come on, let's get out of there. Okay, I'm sorry. I think it's trying to delete my picture. So I'm just going to go over here, back again. So Joe gets 2 cows. He spends $100, gets 2 cows. See how that works? And month number 4 or 3, this is month number 3, cows drop to $25 a head. He's still investing $100, right? He's still investing $100 per month in cows, but the price drops to $25 per head. How many cows does Joe get? How many cows can you buy with $100 if the cows are $25 a head? This is very simple math. So what do you think? He gets 4 cows. Yep, right there it is on the deal. And then the 4th month, so we've got month 1, cows are $100 a head. Month 2, cows are $50 a head. Month 3, cows are $25 a head. And then month 4, 1, 2, 3, 4, cows drop to $20 a head. How many cows does Joe get? So he gets 5 cows. 1, 2, 3, 4, 5. That's month number 4. So let's talk about this. What do you think? What would you do if you were Joe and you started out investing in cows, spending $100 a head, and you get to month 4 and there is disaster in the cow market? Cows are now only $20 a head. What would you? I mean, Joe called me up that month and he was pretty upset. What do you think he was saying to me? What do you think Joe wanted to talk about the month that he discovered that cows went from $100 a head when he started investing in them all the way down to $20 a head? What would you do? What do you think Joe wanted to do? Anybody have a clue? What would you do? What would you do if your investment in cows started at $100 a head and then it went down? I'm looking for comments here. Any comments? I appreciate your mercy. You're with me. Everyone else, I'm going to just say you're out there having a party. By the way, it's Latika's birthday. Happy birthday, Latika. That's for you. So what do you do if you're Joe? Tanya, I think that's right. Harsh, yep, says be upset. Mercy says sell out. Harsh says be upset. Tanya says sell them. So that's exactly what Farmer Joe wanted. He wanted to get out of the cow business. What do you think I said? I mean, if I was your advisor and you had made this decision to invest in cows because you wanted the milk, you wanted the leather goods, you wanted the beef, it made sense for you as a farmer to expand your farm to have cows, and that made sense, and you committed $100 a month to invest in cows. What do you think I would say to you if you were Joe? Tanya says, keep them and sell them later. Mercy gets the extra points here. Another 1,000 free points for you. These are imaginary points, though, Tanya, if you don't mind. But yeah, Tanya, or who says, Mercy says, Mercy, I'm sorry, Tanya, it wasn't you, it was Mercy. Buy more, buy more. That's Mercy, you get the 1,000 imaginary points. Yeah, I'm saying, Joe, dude, look, you were spending $100 a head, now they're $20 a head. I'd sell my John Deere tractor and I'd go buy more cows. And that's what I told Joe. I'm like, dude, do not sell your cows. So as you can see, the next month, cows went back up to $25 a head. And Joe stuck with the program and he bought 4 cows because he was investing $100 a month. He didn't want to increase it. He wanted to keep going at the same price. So I'm like, okay, whatever, the same amount, the same monthly amount. Like you're going to do in your 401k or your investment program. You're going to set an amount and you're going to be investing and you're going to be buying certain things in your investment account and your 401k. Hopefully you set up your portfolio, your asset allocation, and every month, every week, every time you get paid, you're buying more, just like Joe is doing here with these cows. And so the next month they go to $25 a head. He gets 4. The next month, so what month are we on? 1, 2, 3, 4, 5, month 6. They're up to $50 a head. How many do you get for $100? If they're $50 a head, you get 2. And the next month, month number 1, 2, 3, 4, 5, 6, 7, month 7, cows are back to $100 a head where they started. So now we've been investing for 7 months and Joe gets together with me and he says, you know, Jim, I really don't think cows are for me. There's just too much volatility. What do you think? Where are we now? And I said, okay, let's step back. Let's take a quick summary. Let's do a snapshot. You started investing in cows 7 months ago. You invested $700 a month. How much has Joe invested in cows? Somebody give me an answer. It's pretty easy. This is simple math. The kind I like, simple math. How many dollars, how much money did Joe invest in cows over 7 months? Thank you very much. Yes, that's right. I'm not going to say it because if you don't know, you haven't listened. You want to rewind and watch it again. So yeah, that's how much he invested. You got it. It's an easy, simple thing. 7 months, $100 a month equals that number. So now, over those 7 weeks, looking at the chart here, how many cows did Joe buy in 7 months? Okay, I got a number. Did you guys get a number? Are you looking at you can see it, right? You see the cows? How many cows did Joe buy over those 7 months as he invested $100 a month for 7 months? How many cows did he buy? How many cows does he now have in his herd, assuming they all lived, which they did? How many? Thank you, Mercy. That's correct. 19 cows. If you guys can't count, I'm sorry. You may want to go back to counting school, but that's it. It's very, very simple. He bought 19 cows. So let's do the math real quick. 7 months, $100 a month. He made an investment of $700, and now cows are worth $100 a head. How much money would Joe have if he sold all of his cows today while they're at $100 a head, and he owns 19 of them? How much money would Joe have if he sold his cows today? 19 cows at $100 a head would be, this is not even difficult math, so put a comment in for those extra points. Yep, $1,900. So think about it. 7 months investing $100 a month, that's $700. You accumulated 19 cows because the price of those cows went up and down pretty dramatically, which investments, that's what investment values do over time. And Joe was able to buy 5 cows 1 month, and now they're worth $100 a head. So all of the total amount of his investment in cows equals $1,900, but he only invested $700. So what is the profit on that? The profit on that is $1,200. He invested $700. He sells his cows for $1,900. That leaves $1,200 for profit. That's a pretty good profit. That's a pretty good profit. And in my opinion, Joe did the right thing selling the cows while they were at a high price. But I would say to Joe that it's probably not a bad idea to think about how valuable are these cows today to you, and what does it look like in the future? Will they continue to be valuable to you as a farmer? Does it make sense for you to continue to accumulate cows? Maybe not today while the price is at 100, but who knows, cows could go to 200. I mean, this was a while back that Joe and I had this experience buying cows, but you know what? Cows today are going to be a lot higher than they were back then. And so if Joe would have just continued to invest $100 a month, month after month after month, the value of those cows would have went up and down, and Joe would have been able to accumulate more of those cows on the months that the cow value was really low. And on the months where the cow value was really high, he would have only been he would have only been spending $100 a month, so he would have had a limited risk, limited exposure. And so now I want you just to think about, this chart again, this SPY, and instead of cows, I want you to look at those hills and those valleys, the ups and the downs in those charts, and I want you to think about how dollar cost averaging would work in a regular investment, because that's the key thing here. And then not only the SPY, but what if we look at the TLT? That's the bonds. That's just two asset classes, and we could add more. But just imagine over time, if you just accumulate systematically using this powerful strategy called dollar cost averaging, you're going to be accumulating more assets at lower prices during the times when the market has the most volatility and the most fear. And that's why it works, because it spreads out your purchasing power. It allows you to systematically accumulate more assets, especially when the market has drawdowns. Over time, there's nothing that's going to give you a better opportunity to build wealth than using this strategy of dollar cost averaging. So it's a very important strategy. In my opinion, it's the most powerful strategy for folks that are younger than me, who have a longer time to invest. It works like magic. The final investment strategy, and we're pretty much out of time, so let me see if I can get my app to load again. Yes, there we go. The final investment strategy we've covered diversification, asset allocation, dollar cost averaging, and now I'm just going to end with portfolio rebalancing. And I don't have a really good illustration or image, but when we go back to asset allocation, remember I said draw a circle, make it a pie. So if I had my Apple Pencil, which isn't working right now, I'm sorry to say, if we had a circle, and you are going to need to do this in your own 401k, in your own investment portfolio, you're going to make a circle, draw it into 4 quadrants, and have 4 asset classes: large cap, small cap, international, and bonds. And if you did that, over time, what's going to happen is one of those quadrants is going to grow, and let's say the bonds right now shrink, because what happens when interest rates go up? The value of bonds goes down. So let's say interest rates spike way up and the value of bonds goes way down. What are you going to do? Your portfolio is now very much out of balance, right? Because those large cap stocks, the S&P 500, they went way up, but the value of those bonds went way down while interest rates went up. And so now what are you going to do? Sell all your bonds? So portfolio rebalancing works kind of like dollar cost averaging. You do it every quarter, that's every 3 months, or every 6 months, or once a year. You go into your portfolio, like your 401k, and you say, okay, I'm going to hit this button and I'm going to rebalance my portfolio. So now what happens is the quadrant that grew a whole bunch, like the S&P 500, You're going to sell some of that, like when Joe sold his cows at $100 a head. You're going to sell some of that, and you're going to buy some of the quadrant that shrunk because now it's on sale. It's at a discount. And essentially, you're going to rebalance that portfolio. And then you'll rinse, wash, and repeat. You'll do it again the next quarter or the next 6 months or the next year. You don't want to do it too frequently, but you do want to do it every so often. It's called portfolio rebalancing, and it's a nice little, it's a nice strategy to help you maximize returns and minimize risk. So those are the 4 strategies that will help you maximize returns and minimize risk in your investment portfolio. Remember, diversification, asset allocation, which is the most important determinant of your portfolio's returns, asset allocation. So you want to learn about asset classes, and you want to learn how to allocate those asset classes in your portfolio. In other words, how much large cap US do you want? How much international? How much small cap? How much bond? International bond, US bond. That's asset allocation, and it's very important. It's a number one determinant to the results of your portfolio. And then dollar cost averaging just gives you a way to systematically take advantage of the ups and lows of the market. It's a powerful strategy, in my opinion, the most powerful strategy for younger people who will be investing over their lifetime. And the fourth one is just a nice little way to protect those gains and take advantage of those shrinking quadrants or shrinking assets. It's called portfolio rebalancing. So those are the 4 investment strategies that can really help you move the needle in terms of building wealth in your investments. Hope you enjoyed it. We're out of time. It's 11 a.m. So I'll be here to answer questions if you want to post them. I do have a meeting at 11 with one of our students, so I'll be here. If you have any questions, please post them. I will be posting your assignment in Blackboard as soon as I finish my next appointment. I hope you have a great week, and I appreciate you being here. And for those of you who stayed until the very end, take care. See you, Tanya. Take care, Harsh. Bye, Mercy. Everybody else, have a good day. Okay, I'm going to come over here, and I'm going to finish the broadcast.